Good morning, everyone, and welcome to the Moneycontrol live stream. You're watching Markets with Santo and CJ. Of course, there is no Santo today. He's on leave, but I'll be taking over the baton and hopefully keep you entertained. Well, we have a lot to digest today on the show, so let's quickly get to it. In the spotlight today, we are putting the question that is on everybody's mind. How long can the US Federal Reserve keep raising interest rates? I mean, we have already seen interest rate hikes over the past 6 months. It has raised interest rates to the tune of almost 400 basis points in just 6 months in one of the fastest and the most tightest monetary policy hiking cycle in history. That said, the question is then, how long can this party that the Fed is having in terms of raising interest rates continue? Well, if you look at what the market is expecting at this point of time, this rate hike cycle could continue at least till the March of next year. Yes, March of 2023 is when the market is expecting that we will see the last of the rate hikes from the US Fed. Till then, the Fed is expected to raise interest rates by another 125, at least another 125 basis points, bringing the overall Fed interest rate or funds rate, as it is called in the US, to the range of about 5 to 5.25%. Now, what will happen after March? Would we suddenly after March start seeing, conversations around a rate cut? Not exactly. Well, by March, the hope is that the action that the Fed has taken so far will start yielding results in terms of pulling down demand. That will probably help slow the rise in prices that we have seen in the US, which is almost at the 4-decade high. And also, the base effect starts to take effect. And now what is base effect? Is the fact that if you look at from April onwards this year, inflation in the US has been ranging in the range of about 8 to 9%, right? Now, when we fast forward 1 year to April to say April, May 2023, the higher base of this year will make the rate of increase in the prices look a lot smaller, and therefore we will see inflation gradually coming down in the US. That will make the Fed confident that probably it has won the battle as far as bringing inflation down to its target of about 2% is concerned. Now, the market is expecting that from March till November of next year, March 2023 till November 2023, you could see a pause from the Fed as it assesses how its rate hike cycle has affected the economy. At the other end, economists are expecting that in that period, you will start seeing the US GDP start to shrink and possibly the entire economy enter a technical recession or a very shallow recession wherein demand is constricted only for a short period of time. Now, recently, there was a lot of fear that probably the US economy has already entered a recession, but that has seemed to be a false dawn, largely because of the fact that if you look at the job market, unemployment right now is at a 40-year low. If you look at the recent data that has been coming out, Q4 GDP itself has accelerated to over 3% from about 2.6% in Q3 as far as the simultaneous forecasting is concerned. So clearly, the US economy is still being able to, stand tall against the rate hikes that we are seeing. But next year, same time, we could be in a recession in the US and possibly in the global economy as well. And therefore, traders are expecting that by November 2023 or December 2023, we could see the first rate cut coming from the Fed's and arsenal after almost 2 years or almost 3 years since it first cut interest rates back in March 2020. So that is how the market is reading the situation. Of course, so far we have seen that the market has not really been able to convince the Fed that it should play to the script that the market is writing. We'll have to wait and see. But going ahead, this is going to make the situation very tricky for equity investors in terms of calling the bottom in, say, sectors like technology, IT, back home technology in the US, where we have seen a very, very sharp decline in prices overall in the past 12 months. So that is the Fed, and that is the Fed's rate hike path. Talking about today's action, if you look at what is, what the setup is like today and before the bell, the market looks like we are going to be in for a muted start today as well. We are not looking at a very strong session at this point of time. The exchange Nifty is indicating almost a 20-point decline. So the sentiment seems to be a little moderate to a little flat. Apart from that, the cues from Wall Street were quite weak. Wall Street benchmark indices again slumped after that US Fed outcome that we saw yesterday. If you look at the US dollar also strengthened to about 113 handle, which is basically a negative for emerging markets like us, and therefore probably explains why we might get a muted start in the market. Well, the newsmakers of the day. Today, I have three stocks in particular which I feel that could be, buzzing in trade. The first one is, of course, Hero MotoCorp. Now, the company came out with its Q2 earnings on the back of a very muted October sales data. Although the company did indicate that festive demand was higher by about 20% on a year-on-year basis. But if you look at the second quarter earnings, you can understand why Hero MotoCorp has been underperforming in the entire auto pack. The net profit as well as the margins, the operating margins of the company for the second quarter were much below what the street was expecting. EBITDA margins fell about 120 basis points on a year-on-year basis, largely because of higher input costs and also because the company has been unable to fully pass on the higher costs that it has been facing, because the mass market or the entry-level segment where Hero is a very dominant player, their demand has been quite shallow, and therefore the company has had to give incentives to customers, which means discounts, higher discounts, and I think that is one of the reasons why we have seen such a sharp decline in margins on a year-on-year basis for Hero MotoCorp. The next stock today that could be buzzing would be Ethos, the watchmaker, the luxury watchmaker, one of the largest in India, of course, reported very strong earnings for the second quarter, clearly indicating that demand tailwind is there for the company. If you look at the net profit, it rose about fivefold on a year-on-year basis. Revenues jumped about 32% on a year-on-year basis, clearly indicating that the company's recent marketing initiatives as well as strong festival demand during the quarter, reporting quarter, was driving a lot of growth momentum and earnings momentum, and will possibly also explain the sort of runway that we have seen in the share price ever since Ethos got listed in the equity market. Lastly, from the telecom sector, Vodafone Idea. Now, Vodafone Idea, of course, has been one of the most buzzing stocks in the market for the past 3-4 years now. Not always for good reasons, of course, as a lot of its investors would be aware of. But today, the stock will be in focus after reporting its September quarter earnings, which seem to be a little bit of a mixed bag. If you look at headline numbers such as revenue only grew 2% on a sequential basis. If you look at the bottom line, net loss actually widened on a quarter-on-quarter basis to about 7,596 crore, largely because the operating performance in general was quite weak, with operating losses also widening on a sequential basis. But if you look at the ARPU, which is the average revenue per user, and a very, very key metric as far as telecom companies are concerned, ARPU actually improved to rupees 131 rupees per month per user from about 128 rupees in the previous quarter. So clearly, the benefits of the tariff hike that the industry took towards the latter half of last year, it is right now still flowing through into the ARPU of the company. Now, we had heard Bharti Airtel suggest that we do require another tariff hike in the industry, and at this point of time, for Vodafone, it seems like tariff hikes are the only way that the company can keep on improving its operating performance, because as far as the user front is concerned, there the company has been consistently losing subscribers because of its poor network, poor customer service at this point of time. So a very interesting set of numbers from Vodafone. It will be interesting to see how the market reacts and digests these September quarter earnings. Going ahead, hot brokerage bets of the day. Well, the first brokerage bet for me today would be CMS Infosystems. This is a report coming out from JM Financial today. The brokerage firm has given a rating of a buy rating, basically at a target price of 390 rupees. They have raised the target price slightly. If you look at it earlier, it was about 380 rupees, so they have raised it or bumped it up by about 10 rupees. Now, what was the interesting part in the report that JM Financial came out with? They have basically raised their earnings estimate for FY23 and FY24 for the company by about 3 to 4% to reflect the better than expected numbers that CMS Infosystems reported for the September quarter. JM Financial said that the company remains on a strong footing as far as the business is concerned, given that the business model itself is a very sound business model, it's a very solid business model, and JM Financial remains quite impressed by the execution of the from the company. Also, but that said, the caveat here is that CMS Infosystem has seen a very strong position of decline, in its cash position recently. Also, there has been some delay in compliance with some latest regulations also that have come into the industry, and that makes JM Financial a little bit worried that if those two positions do not, or two metrics do not improve in the coming quarters, that could create a headwind as far as stock price performance is concerned. But otherwise, as far as the business model is concerned, and as well as far as the earnings are concerned, JM Financial at this point of time is pretty impressed. Well, next up is, of course, the big daddy in the housing finance space, that is Housing Development Finance Corporation. The company came out with its earnings yesterday, and Phillip Capital came out with a report post the earnings, and they have retained their buy rating and also their target price at about 2,800 rupees. Now, Phillip Capital believes that going ahead, the core earnings of HDFC will see a marked improvement. We had seen some slowdown in the past few quarters, but clearly going ahead, the core earnings of the company are expected to inch higher, largely led by the strong growth that we are seeing in individual loan disbursements for HDFC. If you look at the numbers per se, for the second quarter, net profit rose about 18% on a year-on-year basis. Net interest income rose about 13% on a year-on-year basis. So solid numbers, not spectacular, probably not as spectacular as its cousin HDFC Bank had reported for the second quarter, but still very solid numbers from the company. And ultimately, as far as the credit loss is concerned, in terms of the increase possibly in gross NPAs that a lot of people are fearing because of higher interest rates and how that will affect a lot of home loan borrowers. There, the point of view that is coming in from Phillip Capital is that HDFC's superior know-how in the industry, and of course the knowledge base and the institutional memory that it has, will help it curtail credit loss going ahead. So that is the point of view coming in from Phillip Capital at this point of time. And with that, let's move on to our last section of the day, and that is the stock takes. So these are stocks that I feel probably could be buzzing in trade, and investors ought to keep an eye out on. And first of course, is Rain Industries from the chemical sector. Both of my picks for today are actually from the chemical sector. Actually, not both of them. One is from the chemical sector and one is from the PSU banking space. First up, of course, is Rain Industries. Now, the company's performance in the second quarter was spectacular, especially if you look at it in the context of the decline in price that the stock has seen throughout of 2022. If you look at the Q3 net profit number, net profit nearly doubled on a year-on-year basis. Revenue surged about 45% on a year-on-year basis, clearly indicating that demand trend for the company, at least so far, is very strong. Margins, however, were a little disappointing, but I think that is something that was already in the price, because first quarter and second quarter have been a difficult environment as far as a lot of chemical companies are concerned because of rising input prices. But we know that input prices have come down sequentially, and therefore I think Q3 and Q4 onwards you will see a very strong earnings performance as far as the margins are concerned from Rain Industries. Lastly, of course, if you look at the valuation and risk reward, that has clearly become quite attractive given the fact that despite such strong earnings performance, the stock is down 29% in 2022. And with that, of course, we have the opening bell. If you look at the market, it's been a very muted start, although on the positive side, so that is a good thing. The Nifty bank higher by about 0.3%. The Nifty up about 0.2%, but the Sensex is near the flat line, so not a spectacular start as far as the Sensex is concerned, but the broader market is doing well. Yesterday, the theme was the outperformance of the broader market. So if you look at the Nifty mid cap, Nifty small cap indices, I think they are both in the green and at this point of time outperforming the benchmark indices. If you look at the advanced decline, almost 1,300 stocks rising on the NSE as compared to about 350 stocks that are on a declining trend. If you look at some of the gainers in the banking pack, see clearly a lot of PSU names are doing well. PNB up about 1.7%. Kotak Mahindra Bank higher by about 0.4%. IndusInd Bank higher by about 1.5%. So the banking pack is really what is keeping the benchmark indices in the red, whereas the IT pack is the one that is creating a little bit of trouble as far as the bulls are concerned. Coming back to stock takes, the last stock on my radar today would be Bank of India. Now, very strong numbers from the company. The sort of numbers, that actually drive re-rating and surprise investors by surprise and force them to re-rate or increase their earnings expectation as far as the company is concerned. That is the sort of numbers that we have seen from Bank of India in the second quarter. Now, brokerage from Morgan Stanley also came out with a note as far as Bank of India is concerned, and they have upgraded the stock to overweight rating and raised their price target by 79% to rupees 95 rupees if you look at it for the next 12 months. Of course, every target price that you see from brokerage houses, that's generally concerned for the next 12 months. So that is a humongous sort of upside that Morgan Stanley is seeing. And why they have raised this target price? Of course, because they have raised their earnings estimate for the company, for the lender, for FY24 by 22%. So that is a massive re-rating in as far as earnings estimates are concerned from Morgan Stanley. And clearly, the PSU Bank pack, which has been a spectacular outperformer throughout this year, especially in the past 2 months, I think Bank of India could emerge as a joker in the pack as far as that pack is concerned. So that is it from me on today's show, guys. Keep posting your comments, keep posting your queries. We will try to take them up, in our upcoming sessions and upcoming shows. And also keep following us on the social media links that you will see at the bottom of your screen. And you know the place to be as far as the financial news is concerned for you, moneycontrol.com. And you can also download the Moneycontrol app from the Google Play Store as well as the Apple Store. I'll catch you live at 3 p.m. possibly with a surprise guest on and talk about the IPO market in India. So I'll catch you live at 3 p.m. Till then, have a great trading day.